These Lunch and Learns are brought to you by the team here at Frontline Systems, hoping to deliver value to you, to show you what you have and what you can do. Keep looking on our website and email information for additional Lunch and Learns as they come out. We have a selection of topics coming down the pike between now and the end of the year, looking at some of the new versions, some new features that Sage is bringing out, as well as drilling into existing modules to give you a better understanding of what you're actually using. So we're going to get started. And again, our 3 points are costing types and what they mean, and GL segmentation for the locational record and how to use it, as well as category codes and what they matter. So let's go take a look at costing methods. And ACPAC, as it's formerly known, now known as Sage 300 ERP, has several costing methods available for use. And they are predominantly set up inside of the account set function. The account sets allow you to create multiple account sets. They also allow you to create general ledger attachments, mainly for the asset side of inventory. So inventory control, your payables clearing, some assembly credits, non-stock credits. Most of the clearing and adjustment activity, which predominantly happens on the balance sheet, are controlled by account sets. But account sets use and have the costing methods that inventory item is going to use. And there are several here. So moving average being the most common, also being the way the system holds inventory natively, and we'll talk about that for a minute. So moving average is simply total items in inventory divided into total cost being held by the inventory. So if I have 100 pieces and $100, when I sell one piece, we take 100 divided by 100, we get 1, and my cost of sale is $1. And that is mathematically calculated with each and every transaction going out of the system. Transactions coming into the system under an average simply come in from purchase order receipts with the total quantity coming in and the total cost coming in. Now, if you're using purchase orders and it's a two-step process, so you receive 100 units for $100, but then the invoice comes and there's $10 in freight on it, that $10 is simply thrown into the bucket. And so timing tells you that the costing may not be perfect in the averaging system, because if you throw that $10 into the bucket after you've sold 2, that $10 is going to get amortized against the next 8 units, and their cost is going to ride just a little bit high compared to the first 2 that went out the door. So that's something to be aware of. The average is calculated at the moment the day-end process for that shipment is processed. When we move on and we look at FIFO and LIFO, they are the same technically, the way they're held in the database, but obviously they're opposites of each other. And here, the system builds a new table called an IC costing table, and it keeps the transactions by layer. So when I receive inventory in, it creates a layer with the date, the quantity, and the dollar amounts for that layer. And then when I receive another load of inventory in, let's say 2 days from now, it creates another layer in the IC cost record and keeps the total quantity, total cost for that layer. As I sell product then, it still uses moving average, but it uses moving average within the layer. So when I sell an item that is on either LIFO, first in, first out, last in, first out, or FIFO, first in, first out, simply depends upon which layer that it picks to do its costing method. So when I sell one item, it is going to go down to the dated layer based on first or last one out. It's going to see that I have 100 units at $100. It's going to do the math, and it's going to cost it at 1. But when it comes down to the next layer, I may have had to Federal Express that layer in, so that layer isn't 100 pieces for $100, it's 100 pieces for $125, and thereby when the math is done, those items go out at a higher cost of sales. So these are typically used when we want to keep very tight control over which inventory we're selling, or on some of the first in, first out, there may be some tax implications with rapidly moving pricing. We leave that between you and your tax and accounting specialist to determine if you want to go with either the FIFO or the LIFO layering. But understand that there is a level of complexity that you're adding to accomplish that with this additional table of IC cost. And every once in a while, that costing table can get damaged, and we have to go in and manually readjust it so that it will clear. So don't do this just because. Do this for a purpose, and we are available to discuss those purposes with you, with your tax and accounting specialist, to determine if it's the best way to go. Now I'm gonna skip past standard for just a second. I'm going to come into most recent cost. So most recent cost simply says, what did I pay for it the last time, sometimes referred to as landed cost, and that is the price that I'm going to sell it at. So I'm going to ignore the averaging, and I am going to sell it the most recent. Now, that can create some variances in the inventory costing. If your most recent was $1.10 and you've got an awful lot of inventory sitting at $1 and you sell it all, you're going to have a quantity of 0 with a negative costing number sitting in that because you have actually overcommitted the cost of sales. So you can end up with this situation where you have no inventory on the shelf, but you have value, whether it's positive or negative, because the most recent cost did not fully consume or over-consumed the values that were sitting in inventory control. So user specified, here is the costing method that we use when we're non-stocking things. So I've got an item number to reference the purchase of a component that I don't keep in inventory. It's a special order. My client calls up and says, I want one of these. I actually call to find out what the cost is. I get the cost, and then I come back to my client and I quote it to the client. They accept it. I place an order for it and put in the quoted cost in my order entry, and I have an additional bucket. My additional bucket says what's the cost of this item, and I can put in the quoted cost from my vendor for the cost of that item. So it truly becomes a user-defined cost. Now this is required on any item that is flagged as non-stock. So we do not track quantities or value dollars on anything that is determined to be non-stock. That's a switch on the item master record. Is it stock or is it non-stock? And so if it's non-stock, you're saying, I do not wish to track cost, I do not wish to track quantities, therefore I am going to use a user-specified cost, and I'm going to tell the system what the cost is with each and every instance of that item number. Okay, so serial and lot tracking work very similar to FIFO and LIFO in that they build a costing layer. That costing layer is attached to the serial line or the lot line for that item. But it is a way to attach cost specifically to one item, serialization, or a group of items in a lot. So if I'm bringing in a roll of carpet, that may be a lot because I'm going to cut pieces off of it. And so I may want to bring in and cost that roll of carpet specifically so that as I cut pieces off of it, I get the cost associated directly with that roll of carpet. Consequently, if I bring computer parts in and I track their serial numbers, let's just say hard drives as an example, because computer parts can tend to be a commodity item, I may have a different cost for that hard drive that I bought a week ago than its replacement that I'm going to buy today. So I don't particularly want to average them together. I want to know specifically what the cost of each and every one of those hard drives are on an independent basis. Therefore, I would cost by my serial number. So structurally, it's the same in that your cost is a quantity of one and a dollar value being held on the serialized line, so that when you sell it and attach the serial number, it brings the cost up out of serialization. Okay. So now let's go back to standard. And I held standard off because it's a little bit different. And those of you that are using manufacturing systems, particularly if you're using a product that was available in the 300 region called MISIS, most manufacturing systems normalize to standard cost on the inbound activity. So if you have a standard cost of $1 and you buy a product at 95 cents, the system, when you receive it, will normalize it to $1 and give you a purchase variancing of a nickel. Okay, that's pretty standard. But in ACPAC, in Sage 300 ERP, we don't do it that way. And we don't do it that way because all inventory is held at all times by total quantity, total cost. So when you run an inventory valuation statement, it is giving you the base inventory, the only one that matters, the one that ties to the general ledger, is being held by total quantity, total cost. Now, it might be supported with an IC costing table for LIFO, FIFO, or it might be supported with a serial and lot tracking table in the consequence of using serial and lot for costing. But internally, it is always tracking at moving average. Now, it's not costing at moving average, but in the sense that it is always holding total quantity, total cost. So that's the way inventory is held in the system. So the standard cost is normalized on sale. So if you have a bunch of items that you've received in at 95 cents and their standard is $1, unlike a manufacturing system which will normalize that on the purchase, Sage 300 will hold it at 95 cents. So when you run the valuation statement, you will get 95 cents times the total quantity on the shelf, 100 units, let's say. So you get $950 for a value versus $1,000. But when you sell it, it will bring a cost of sales forward of $1. So when you look at your revenue, $4, and your cost of sale, $1, and that cost of sale won't move, it will come out as standard. But you will have a variancing account, which will take the nickel. So it's a timing issue of when the variancing is done. And the only reason that's important to understand is if you are doing assemblies or other applications to the inventory, is the base for that application isn't necessarily $1. It might be 95 cents, and it might be combined with other things that are a quarter or 26 cents or whatever their cost is, and it will come out at an assembled cost of $3.50. But its standard is $4. And so when it is sold, it will send $4 to cost of sales and take a $0.50 variancing off of the inventory. So inventory will get credited for $3.50, and the variancing account will get the credit for 50 cents, and cost of sales will get the debit for $4. Okay, so it's important to understand that the timing of standard inventory costing method is at the time of sale, not at the time of purchase. And that's an important point. Okay. Any questions on these costing methods? The only point that I'll make is that you must have an account set for each costing method that you use. You can have multiple account sets all using the same costing method because you want to change general ledger numbers. Maybe you want to hold assets for different inventories in different places. And you can do that by making multiple account sets all using the same costing method. Okay? So we'll come back, and if you have questions along the way, we'll have some Q&A at the end. We're going to move on to the next point that I want you to look at, and that's locations. So I'm going to go ahead and close account sets and go into locations. Now, locations can be physical locations. I have a warehouse in Minneapolis and I have a warehouse in Chicago. They can be virtual locations. Within my warehouse, I have a raw materials area, I have a Q&A area, and I have a ready for sale or production area in place. So inventory locations can be whatever we want inventory locations to be. So a couple of key points on inventory locations, and then we'll look at the integration. First off, inventory locations can hold separate costing by location. So it may be less expensive to bring items into my Chicago warehouse than my Phoenix warehouse. Trucking costs may be different. Maybe the vendor is closer to Chicago than they are to Phoenix. So costing can be different coming into each of the warehouses. Consequently, there is a function, we're not going to look at it, but there is a function to transfer inventory between locations, and you can burden that transfer with the cost to move it, whether you ship it by UPS or ship it by your own truck or ship it by a contract carrier. You can burden it with the cost to move it to the other location. Therefore, the inventory coming out of Chicago will vary from the inventory coming out of Phoenix. Okay. But what we want to drill down into now that we have a warehouse location is this function on the integration tab where we can override segments of our general ledger number. So here we are setting it to override the segment for region. So I may be costing in my sample data, I have region as an identifier, and I may be costing from the region. So it's assumed that if I'm pulling inventory out of my Chicago warehouse, I'm probably selling it within the Midwest region, and I want to override all my costs based on that. So when you set a GL override segment override here, you can set it to one or more segments. It doesn't depend upon how your general ledger is structured. And any GL number associated with a locational transaction, whether that's a purchase, whether that's a sale, or whether that's a transfer, any item associated with this warehouse transaction, if it has region 10 as an option for that GL number, it will assign it to region 10. So you could put not only your asset account for the Chicago warehouse, but you could do revenues and cost of sales if you wanted to. Now, you don't have to. If they don't have region 10 on them, it will simply pick the next level above it. It will drop the segment override to it. But this is a way for you to segment inventories by location relatively simply so that when you look at the balance sheet, you have something to tie to it. That's one way to do it. The other way, of course, to do it is by each of those account sets. You could create 3 account sets, put 3 different inventory asset accounts in there, and attach all the inventory that sits in Chicago to one account set and all the inventory that sits in Phoenix to another account set. But what happens if the same item is in both warehouses? Now account sets don't work because they are attached to the item. And so now I need a segment override if I want to control or send general ledger transactions based on the warehouse that activity is happening in. I can't do it with account sets because I hold the same fluorescent desk lamp, sample data, Ron Black fluorescent desk lamps. I hold the same fluorescent desk lamp at both locations. So therefore they have the same account set on them, and they are costed in the same method because the item number can only have one account set. So I need overrides based on their location to do those general ledger transactions for me. So to set the override, you simply click it on or off. You can come in here and pick which item you want through a drop-down. Now I only have division left because I've already picked region here, but if I was doing it originally, I would have both division or region available to me. And then once I do that, I can come in here and I can look at the available authorized segments in my general ledger to assign that to. Okay, so that's all there is to setting it up. It's a static. Once it's in there, and it will start to do those assignments in the back end automatically without user intervention. So it's a good use. Think about how it may impact what you're doing in your locations. Again, if you have questions on the usage or you want to run scenarios by, that's what we're here for. So make sure that you contact us, and we'll get an inventory person on the line with you to go through and discuss why you may or may not want to implement segmentation based on inventory locations. And so we're going to move over to category codes and what they mean and how to use them. And then based on the amount of time that we have, I'm going to show how category codes and account sets in particular can be used as reporting subgroups, and so we're going to talk about that a little bit. So if you remember, we said the account sets hold the costing method and they hold the asset-related information of an item. Category codes hold the sales-based general ledger activity. So our sales, our returns, our cost of sales. Here's that variancing account I told you about, that if you're using standard cost when the item is sold, the variance goes into the variancing account. You've got a damaged goods account. This is when you're doing returns. You can flag an item as damaged, that it is not going back into active inventory, and then it will get costed out into this location. And there is now, in the more current versions, an internal usage function. So if you have an engineering desk that takes pieces out of inventory to test solutions, we now have an internal way of capturing those items coming out of inventory control and a place to cost them based on this category code. The other thing that category codes do in their basic structure is they can set a default price list, as you see here. They can also be used to track commissioning rates. And lastly, they hold taxes. So the taxes are an important piece here. If you're not using one of the connected tax services, such as Avalara, which is called Sage's tax service, powered by Avalara, then you need to build out taxing authorities for your inventory items. And typically you need to build out every authority that you are involved in. Because if you try to sell an item without the authority on the item master record, you will get an error that that authority does not exist for the item, and you'll have to correct it. By putting taxes on the category code, when you create a new item, it will put those inventory or those taxings on the inventory item by default. So if you get these built out correctly, before putting a lot of items into your inventory control, you will reduce the amount of effort that has to happen later with those inventory control master records. Now, a note, if you add taxes to a category code, they will not update on the item master records. So if you have to add a tax authority, or if you start selling in a different state, and all of a sudden you pick up 5, 10, 15, 20, 100 new taxing authorities, those taxing authorities have to be brought onto the master records to support them, and that is an importation process, and they have to be imported across the master records one at a time. So you import 10 times to get 10 new authorities for the state that you're in. And you can start to see that if you work in places like California, Mississippi, not Mississippi, Minnesota, Texas goes all the way down to the school board level for taxing authority. It can be very arduous, which is why if you're doing retail sales across multiple jurisdictions, you may want to look at the Avalara solution. But coming back to category codes, if you're manually managing your taxing, you always want to make sure that all your authorities are on your category, so when you create new items, it automatically brings all those authorities onto the master record. Okay, so in theory, we need one category code because we only have one sales revenue, one return, one cost of sale account, and we put all our taxes on it, and we're good to go. But category codes go so much farther than that, that they are used often to segregate inventory, to look up inventory, to report on inventory. And so you need to think beyond just the functions of taxation or just the functions of general ledger activity. And you need to think about, how do I want to look at my inventory? How do I want to report on my inventory? And then you want to use a combination of account sets and category codes to build out a more robust reporting environment. So for example, my account sets are typically can be used to break up big groups of inventory. Retail items versus commercial items, raw materials versus finished goods, right? Big groupings of inventory control we can set different account sets for. Now within those groups, we can now create category codes. So if we look at our sample data, they're creating category codes of things like accessories, packaging, tiller chairs. Well, I might have tiller chairs at a retail and a commercial level, but they're all tiller chairs. So that account set can be used to break down inventory in a more micro grouping, but it can also go across both account sets. So I could look at all tiller chairs in my retail and my commercial groupings, or I can say I only want account set retail, category code tiller chairs, and I could break that down even to that's more small finite. Or I could just say I want all account sets for retail, and I could look at all the items in my inventory that are flagged on the retail side versus all the items that are flagged on the commercial side. Okay? So this combination of account sets and category codes goes way beyond costing methods, general ledger, taxing, etc., and now comes into reporting. So let's go take a quick look at reporting just to show how this is done. If I come into the stock control reports and I simply come into an item valuation statement, so I have a lot of ability to sort, slice, and dice here. The first off, of course, is I can identify if I'm going to do location details or individual transactional costs. We'll do locational details because that's what the older systems did. You didn't have this ability to drill down. But I can now print separate by location, items by location, or consolidate my locations. I can do them in detail or summary. Summary will give you one line item per location. I can include, remember I said that you had positives and negatives and zero quantities, so you can do all that. But here's where we get into the keys. From account set to account set. So from account set, now they've got these done up by this sample data. They've got these done up by their costing method for obvious reasons, because it's a demo package and I want to show you the difference. But this could say commercial. So I want to go from and to commercial. I may want to pick a specific location. I only want to see commercial products that are sitting in my Phoenix warehouse, and so I could identify it down to my location. And then I can come down here and I can say sort it by. Now notice one of those is category code. Now I have a lot of things that I can sort by, but one of those is category code. So the minute I say I want to sort by category code, I can now restrict it to only my tiller chairs, like this. So now the only thing if I leave this just the way it is, I'm looking at everything, all the costing, all the account sets, all the warehouse locations, but only for tiller chairs. If I want to see tiller chairs in a specific warehouse, I come in, click the warehouse activity, and now I'm looking for just that category code in just that warehouse. And then if I only wanted to look at the retail tiller chairs, the ones we sell to the big box stores of Home Depot versus the ones we sell to the office products and office design shops, then I could do that using account sets potentially. Okay, so what I want to leave you with here is on these three types. Account sets are costing types, and we went through what they mean. They're GL numbers, and they're reporting. Locations are physical or virtual and can have a segmentation override on them. Category codes hold your sales and cost of sales general ledger assignments, can also be used for reporting, and have the default taxing structure on them. So these are three very, very key pieces that need to be set up correctly so that as you create inventory items, you get the GL assignments you need, the taxings that you need, and ultimately the reporting that you need. Because much of this is pulled up into your sales order entry, so when you start doing sales analysis, it becomes more and more and more important.